Going to be a lot more conscientious. And even though I said that I'm not going to post my lecture notes because they're relatively simple, I might bend a little bit. Jonathan has posted his already from last week. And he'll probably do a short update at the beginning of the second half of the lecture on the materials he covered last week. I didn't really cover anything that would be exam material. I just gave you background on myself and some context for the topics we're going to discuss. But does anybody have any questions for me before we get started? Yeah. Yes.
Any deals you can tell us you're working on?
So I am not working on any equity deals. I'm raising a new fund. So I hope the investors don't say, the limited partners that are going to be investors in the fund, don't say like, hey, so what do you have in the queue? Because I'm not planning on going out and finding deals until we actually have money to invest. Because otherwise I will line up deals and then somebody else will get them by the time I get my fund actually. I did see an interesting firearms company. They're a weapons manufacturer. Because I sit on the Salt Lake County Enterprise Loan Fund. It's hilarious to see folks in the banking industry do we have folks here in the banking industry? We have a couple. Yeah. So it's interesting. I've got a bunch of folks who essentially say, with all the big banks in town, I mean, American Express is on the board and a couple of others, and Salt Lake County puts some money together, and then the banks put a bunch of money in, and we all spend it for them. I do this for free. Like once a month, I go down and help them make investment decisions. And it's funny because to hear the county and the banks, they say, oh, we can do this, and it doesn't really step on the normal economic model for businesses because all these companies are not bankable, right? So American Express says, yeah, these companies are not far enough along for us to be able to have a regular bank loan or a line of credit or something else. So therefore, we should have this loan fund we put together to invest in these businesses. Does that strike anybody else as odd? Or can anybody see why, from my perspective, since I don't work for a bank, I see that as a little bit unusual?
Yeah.
Because they're ostensibly some kind of good investment.
Well, the weird thing is they're making bank loans. Like they're higher than regular interest rate loans. Like the interest rates are in the teens for these companies. But these companies can't go to the bank and get a loan because they're not eligible. And we'll talk about why that is in a minute. But they certainly could go out and get early stage venture capital, right? They could get equity backing. But in the banking world and in the accounting world, they don't even think about that. They're totally oblivious to the fact that, yeah, you've got a bunch of banks in the room and that's totally cool, but there's a bunch of people called venture capitalists and angel investors, and those folks write checks to these kinds of companies all day long. So I just been kept quiet so far. I'm waiting to see if it comes up on my year tenure as a board member.
So why would they, why would somebody use their money as opposed to just going to venture capital guys?
Well, we'll talk about that in a minute. But does anybody want to take a shot as to why somebody would take county money instead of going to venture capital? Like this is a loan fund.
They don't grab much equity or any equity.
Yeah, they don't take any equity.
Yeah, it's a loan.
I mean, it's not because they're going to be able to pay off the loan, and that way they're all free and clear, and they have 100% control of everything they own.
So let's talk for a second about these two issues, right? Unless we got any other questions for me before we start class. General questions on the class, questions about your groups, questions about whether we're meeting or not next week. Does anybody know the answer to that? No, we're not meeting next week. Very good. All right, so then let's talk about debt and equity. What is equity?
Piece of ownership.
Yeah, so equity really means ownership. Okay? And debt is what? Somebody give us an example of what's debt?
A loan.
That's a loan, right? So on the one hand, if you take $100,000 from somebody, and you take a loan, you have to pay that back. If you take $100,000 from somebody and give them equity in your business, you have to give the $100,000 back?
No.
Not necessarily. You might end up giving a lot more than $100,000 back. Or you might end up giving zero back. Because they effectively own a percentage of your business, right? So that's the high-level difference between what debt looks like and equity looks like. And we'll talk about that a little bit in the context of where you go as an entrepreneur if you need money. So why can't you just go to the banks?
They want a track record.
Pardon?
They want a track record.
They want a track record. Well, so venture capitalists sometimes want a track record. Like, what have you done before? How do we know you'll be successful in this business? Like, but specifically, when you say track record, what does the bank want?
Something established, something that tangible that they can sell if you fail.
Yeah, they want an asset, right? They want something physically that they can recoup if your business goes sideways, so that they can sell it and get either all their money back or a good portion of their money. They want a collateralized loan that they're going to give you. So if you're an entrepreneur and you have an idea for a business and you walk into a bank, what do you have to collateralize your loan with?
Your house.
Your house, right? You can do a personal guarantee on a loan, I guess. You know, some banks would take that. How about the venture capitalists? Are they going to ask you to write a personal guarantee, or you're going to have to basically put a second, mortgage on your house, or sign over your personal assets as a guarantee?
So VC would you have to release a prototype? Something that they're backing.
It really depends on the model, and we'll talk about that too when we talk about the stages.
The reason I ask that is taking Rob Venture Trends and planning stuff, is we're talking about how do you get to those steps where you can actually go to a bank or go to a VC and establish yourself, whether it's collateral or a prototype, and that's where angel investing, crowdfunding comes in.
Well, since you've been in Rob's class, I'm going to put you on the spot to answer a question that we want to answer even before we answer that one, which is, where's the first place you would go for funding these services?
I mean, maybe friends, family, classmates, the people around you.
I think there's some possibilities before friends and classmates.
Credit card.
Yeah, so credit cards.
Having learned from last class, Jonathan, credit cards.
Yeah.
Your visionary model is. All right, credit cards, friends and family. Anything else? Home equity. So personal debt, I guess. So savings. Okay. Anything else? Is there any chance you could start a business and you wouldn't have to spend any money out of pocket? Yeah, right? You might be able to build a business with some sweat equity. Can somebody give me an example of a business that you couldn't build with sweat equity? Rob's idea in his class is like, well, you can borrow, paper clips and stationery and like all sorts of stuff from your current employer, which is can get you in some trouble. But can somebody else give me an example of something that maybe you couldn't start?
Maybe a delivery company.
Delivery company? And how come you couldn't start that with just sweat equity?
You can start within the neighborhood,
Okay.
so you'll walk your,
Yeah, if you had shoes, you could do that, right?
yes.
But if you need a bicycle, you have a bicycle, you need some capital. What's a really capital-intensive business? Yeah.
Take some like Google, where you just, the business is not going to be able to get out to the same amount of people without some kind of funding.
Yeah, so Google took a bunch of money to get started. But are there types of businesses that are even more capitally intensive?
Construction.
Construction, manufacturing. What's the most expensive manufacturing business?
Cars.
I see chip.
Yeah, so integrated circuit company, if you decided to build your own fabrication plant, what does an IC fab plant cost?
I don't know.
Yeah, so we'll just say it's around $1 billion, right? And maybe it's going to be like putting $1 billion on a credit card to build a fabrication plant. American Express doesn't have a limit, do they? Okay. So you get some ideas as to why some businesses are better suited for this spectrum, okay? But when we get out of these friends and classmates, does anybody have friends that invest their own money in things? Like outside of like the stock market? Yeah? Okay, so tell us about that.
He runs, he's the managing partner of the Union Venture Capital, and we work with the technology commercialization offices of several universities, including UC.
Okay, but you said he invests his own money, right? So he's got a role that's a little bit farther down the spectrum.
Well, yeah, so he does some of his own investments.
So what does your buddy Taft call himself when he makes these investments with his own? All right. What do you call somebody like that?
Angel investor.
Angel investor. Why do we use the term angel?
So,
Can't do much more, as they're coming at an ideal spot in the financing process where without somebody coming in, these bills can't like fly, or we can't go out and raise more money.
summarize what you, go ahead.
Come in as a gift from God, as
To-
an angel, to bless you with their money.
Bless who? Who's you in that case?
The company,
Yeah, company, the entrepreneur,
the
right?
entrepreneur.
Yeah, so the angel is really an angel to the entrepreneur, as opposed to, who else? The devil. Who's the devil? Who's not the angel in this model?
Bank.
Well, banks, probably, but there's some bad guys, some people consider someone on the spectrum even worse than the banks.
I have a couple of clients that top venture capital companies.
All right, so we'll put venture capital right. Anybody ever heard of the derogatory term for venture capital?
Corporate raiders.
Yeah, so I think corporate raiders are even farther down, but I heard vulture capitalists as a term for venture capitalists, right? The carry-on eating birds. I've also heard venture capitalists refer to entrepreneurs as, anyone take a guess, derogatory term? Entrepreneur. Yeah, so there's, a little bit of play there. I would argue that seed capital is sometimes considered earlier than venture capital, right? Because you're essentially seeding these businesses from scratch. But you take an interesting jump here as you get from friends and classmates when you get to angel investors. You actually make a distinction where you're talking about folks that are not sophisticated people that make investments, and then you're getting to semi-sophisticated. Some of these are more sophisticated than others, and then you get into actual corporate entities that are supposed to be making investments. So one of the distinctions, we'll talk more about this later, is you get something different as an investor when you cross this threshold usually. When you give your $100,000 as an investor, what do you get over here? We're going to decide it's not debt, so it's equity, right? So and when you get equity, you also get stock, okay? What type of stock do you get over here? You don't get preferred stock. If you're not getting preferred stock, what kind of stock do you have? You get common, right? So over here you get common stock. And over here you get preferred stock. What's the differences between common stock and preferred stock? Anyone guess? So sometimes liquidation, sometimes voting. When you group all those things together, they turn out to be preferences, right? So the high-level summary of what's in preferred stock, we're going to be talking about this in about 6 weeks, is you get preferences. There are preferences in preferred stock over common. That's what makes sense. Okay. So how about Mercado? How about my firm, Mercado? Is Mercado a venture capital firm? Sort of. Who would say yes? Okay, why would you say yes?
You guys invest in companies that are small to medium size, looking for money.
Yeah. All right. Who would say no? Yes.
For your fee, is it getting in at later stages?
So, interestingly, when Mercado started, they pitched themselves as a venture capital firm. And then it turns out that the limited partners were more interested in private equity firms than they were venture capital firms. So when we went to market the second time, we became a private equity firm, and all the words venture disappeared from all of our marketing materials. Now, it's kind of a fair switch, I think, in Mercado's case, because their investments in Mystical Candy and Fusion.io and MetaConnect were relatively late. Fusion.io actually was one of the earlier ones that was highly creative. But it's really just a difference of semantics.
So fund one would be venture capital and fund two would be private equity.
No, so that's unusual, right? So typically those are defined by the stage that you invest in. And usually investors stay in one particular stage. So if you do early stage seed, then you don't do private equity investments. Right? You don't do what we would normally call expansion capital. Or also called growth capital. That's when we put this.
And the idea being that you create a firm that gets really good at venture capital, that's what you're good at when you finish your first fund. You do the same thing again with new companies, and the private equity guys can take the next stage, and they're actually the ones liquidating your positions, creating the cash to give back to your investors.
So usually usually folks stay within a particular niche. Why is private equity a weird term? What's public equity?
Stocks.
What kind of stocks?
Well, just something that's traded publicly.
Yeah, so publicly traded stocks, right? So if the stocks that we're talking about are not public, then they would be,
Right.
but aren't all these things private? So here's the weird thing about private equity, right? Private equity is this umbrella term for all of these types of investments. But in some circles, folks also refer to private equity as later stage growth or expansion type capital. Is that fair?
Yeah.
Okay. So, when I met my buddy Tony, who before he got married threw the most unbelievable parties in New York, right? Which is where you always meet, your future job contacts. So I've never missed one. So I got invited to. When I'm hanging out with Tony and his hedge fund buddies ask me, what do? What do I say?
Private equity.
So I can say I'm in private equity, and which one do I mean? So I actually mean this one, right? In fact, I'd probably more likely say I do growth or expansion capital, right? And I probably would say, I also invest in these type of vertical segments. In my case, it's consumer products and technology. And I do expansion capital investing. And then those guys have a pretty well-defined idea as to what I do, right? If I'm at my grandmother's house, and my grandma says, now remind me, Kenny, what you do again? What do I say? Then I say I'm in private equity, right? And I say, oh, you know how my dad, who's a financial advisor, is in public equity? Well, I'm in private equity. So I invest in things before they go up. My grandma's like, oh, I get you, right? So the context is a little bit different. And which term you use really depends on what the audience is. But if you want to talk about this and you want to look smart, just remember, you can talk about this in an umbrella term as private equity. But people inside the industry will usually use a more specific term if you're talking about this. Okay. All right, so going down on this continuum, we're really talking about ways to get money into your business. Although it's also a little bit of a continuum on a timeline, right? So the longer your business has been in business, the more likely you are to be down this continuum. What's the last place? What's kind of the final place? Companies do money. Okay, what's an IPO? What does IPO stand for?
Initial.
Okay, so initial public offering or IPO. Okay.
That's right before it gets bought out by a private equity.
Yeah, because then you mean because then Dell gets,
Then it goes private.
then it goes right to the ground and somebody buys it back and turns private again. So the idea is that when I'm talking about the private equity spectrum, once you get to IPO, then you're in the public equity. And one of the things you typically do in IPO is you raise money for some particular purpose, either for liquidity of previous investors or some future use of capital for something you need to be able to finance, or frequently a combination of both.
What are we missing before IPO, late stage, buyout, anything else?
So I put a particular term here. Does anybody else want to take a guess? Sometimes I actually use two different terms in this work. Yeah.
Is it issuing bonds?
It's probably bonds, right? Because we're talking about the equity world. So bonds are a debt mechanism. I usually see bonds referred to on the public debt side. But you have lines of credit and other types of debt-based financing that you can do on the public. Anyone else? Or the private, excuse me. Anyone else want to take a guess? Jonathan, you want to throw one out?
Buyout is supposed to be in there.
Yeah, so I would say buyout. What are buyout firms do?
All that stuff where you can partner up with someone else, you can get bought out by a larger company. And that might take into private to public equity again, but buyouts like I'm thinking, not public as well, an Adobe buyout. Goodness gracious.
Omniture.
Thank you, Omniture.
Yeah.
There's a whole bunch of stages in there where if you have a successful model, you can definitely take the company where you want it to go immediately.
with mergers with other companies at some point, right? But I think a buyout, at least in one aspect, is consolidating all of the investors that came prior to them so that they have control of the company going forward, complete control of maybe the 3 or 4 venture capital or private equity firms that have got a piece of it so that they can better control the exiting of the IPO market.
Yeah, and sometimes they do that just so that they can control who's going to sell in the IPO, which helps keep the price stable. Sometimes these firms exist to kind of consolidate management functions or to get rid of duplicate functions inside a company. So somebody that does a roll-up, is typically considered in this buyout sort of category. Let's take a bunch of vendors in the, say, public key encryption space and let's figure out how to consolidate them into one business that's better than all the rest of the smaller business model. I also sometimes heard the term mezzanine fund thrown around. Not as a debt addition. You heard that term as well? When I'm in the private equity world, I usually think of a mezzanine fund. Does anybody know what a mezzanine is? Like if you go to the opera, you sit in the mezzanine. Yeah, so it's just in between these other levels, right? So I really see the mezzanine as kind of in between the growth and expansion stage and the buyout stage. Also, sometimes there's a pricing mechanism that happens sometimes in these mezzanine funds where you've got a company that has this run-up where their stock's like $1 per share, and they're going to go public at like $500 a share. But there's some folks that are nervous about spending, 500 times what the last round valuation looked like. So a lot of times a mezzanine firm will come in and say, look, we'll buy a bunch of shares at $350 a share because we're confident that we're going to be able to sell them at $500 a share, and that gives, some folks a comfort level that there's an institutional lending firm that vouch for something reasonably close to price. We won't spend a lot of time talking about mezzanine funds, but I think it is relevant for you, and I will ask you on an exam, what are the different stages of the investment capital in and why is it relevant? Let's talk about a couple reasons why it's relevant. One is the time spectrum. As time goes by, or as you build more revenue or get more profitable, you're more likely to be on the right-hand spectrum. But there's also a couple other mechanisms. If you're looking at risk, which side of this continuum is more risky?
Left.
The left side, right? Because your company's not as far along and there's less proven, you have hit less milestones. All right. Which investors are more likely to spend more money per round? One's on the left or one's on the right? So the more dollars per round is on the right-hand side. So the deeper pockets go this direction. Right? It's not unusual to have a venture capital fund, or I'm essentially going to raise a seed fund that's like $10 million. It's not unusual to have a buyout fund that's like $3 billion. So the fund sizes get bigger as you go left to right, but the amount of the investments that get made get bigger as you go left to right. And the total amount of funding that will go into any given sort of business will get bigger as you go. As the companies get to be later stages and the valuations for businesses get higher, but also the use of capital. The companies on the right spend a lot of money in companies that are in these stages on the right. All right. We talked a little bit about the fact that there's the split between common and preferred stock. There's more preferences traditionally for businesses as they get farther towards the right-hand side. Right?
What do you mean by more preferences? Like they call the shots in business a little more?
Well, that's an easy way to summarize it, right? Because I haven't told you what preferences are yet. A couple people threw out a couple different types of preferences. But let's just say that whatever it is that's preferred, things that differentiate these two, there's more and more and more of them typically that accrue this direction. And it's really about your comment about control, right? So typically, the ownership percentage that the investors take, what do you think? It's going to be higher or lower on this right-hand side? The investors own more of the business or less of the business? More. They're going to own more, right? So the entrepreneur right here owns 100% of this business. Okay? And once the first investment comes out, the entrepreneur is going to own some percent less, right? If the investor takes 20%, the entrepreneur is going to own 80%. Using the entrepreneur like generically for all people, right? So sometimes that's the CEO, sometimes it's split between two founders, sometimes there's a team of like a dozen people. But whatever this ownership percentage is, it doesn't get any bigger as you go down the continuum. It only gets smaller for the entrepreneur. So if the investor, in this case, is picking up 20% ownership, the total amount that the investors have, will just continue to grow and grow and grow. And the interesting thing about the buyout firms, in relation to your control argument, is typically buyout firms want to have some sort of guaranteed control of this. Right? Yes?
When you're looking at it, is each, obviously there's going to be some negotiation, but is there general terms that the angel investor, seed and venture are going to look for and be able to get out of it? Like general say, we want X amount.
Yes. There are a market set of terms. And when we talk about preferred terms in about 6 weeks, you'll have an actual book that says, look, here's what market terms were, at least at the time the book was written. Here's a liquidation preference. Here's what's market for a liquidation preference. Here's observation rights. Here's what's market for observation rights. So you really need attorneys on both sides, but if you get good attorneys on both sides, it's a relatively easy negotiation for the investor and the firm to be putting money into companies because there's some sort of general agreement. Now the valuation is another story, right? What do you think? The valuations of these businesses, higher on the left, higher on the right in terms of raw dollars. Higher on the right, right? These businesses get more and more expensive as you go left to right. Valuation is something that they always argue about. Entrepreneurs and investors always argue about. Other question? You good? Yeah. Other questions on this continuum of what the investment world looks like? Again, keep in mind that private equity is a general term for all of this stuff, but it also refers to a specific subcategory. One of the investment stages that's after venture capital, but sometime before that. Okay. So we've already talked about the fact as an entrepreneur, you can't walk in to the bank and get money, but you could, starting on the left-hand side, try and get money from these. Where does this money come from? We did a high-level diagram of this last week. If you're talking about investment firm, and investment firms also described have funds inside them. Where does the money come from to go into this fund? Is it just a bunch of super rich dudes that like invest their own money? So as a general partner in a firm, right, you guys are, as a team, going to be representing the general partner. Are you representing somebody that has like an enormous amount of money and you're writing a check out of your checkbook? They do that on Shark Tank. Don't they write their own check out of Shark Tank? Not venture capitalists. Shark Tank, as far as I know.
What would Shark Tank be considered on this spectrum?
I think Shark Tank are angel investors. I mean, aren't what's his name? The Dallas
Mark Cuban.
Mark Cuban, right? Mark Cuban spending his own money, isn't he? On that show? Yeah. So Cuban, angel investor. So where does money come from if it's not their own money? Limited partners. That's from limited partners, right? Well, what other kind of partners are there that are limited? Are there unlimited partners?
General.
There are unlimited partners, only they're not called unlimited partners. Anybody remember what the unlimited partners are called? They're called general partners, right? And where are they in this drawing? They're the firm, right? So Jonathan's put much more detailed slides together, so I'm going to simplify these brutally. But essentially, you have limited partners, and they're limited in a certain way, and you have general partners. In what way are limited partners limited? Liability. So they're limited from the liability standpoint. Okay. Anything else? What enables them to be limited from a liability standpoint? What else are they limited in? Decision making. Yeah, so participation, control, information, in any of those things, right? So they're limited in a couple different ways, but essentially, they have the money which goes into these funds. Now, what types of limited partners are there? What's an example of a limited partner?
A hedge fund or endowment or a pension fund, all limited partners.
Yeah, so endowments, a good answer. I'm going to skip the hedge fund question for a minute because most of the hedge funds I know do public investing and not private investing, and they're usually, I find them to be more co-investors with this group of folks than investors in these folks, but I know that that's not 100% true.
They'll do private equity too, right? They'll take position in that, even though they'll have a portion of their fund, right?
Well, you do hedge fund investing.
Yeah, so they're more likely not to invest in Ken's fund, but they may find a deal that suits their fund too. You find a portfolio company that they want to venture capital fund it in. But it would be part of their overall strategy, which really, if you look at the diagram I made of the fund structure last week, it's very similar to how a hedge fund works. And so they're making those investments directly rather than relying on a private equity GP.
Are most of your hedge funds on the public side, or are they mostly on the private side?
No, I mean, the
You had to guess at a
the
split
simplest to
percentage.
talk about is like an equity long short, in which case that's very true, or an activist manager where they try to get a control percentage for voting. But we got people that are they're buying bankruptcy claims. So extreme private credit, global, and probably I would say institutional hedge funds. You probably got 15-20% of your public.
Well, let me go this. You put hedge funds in the alternative asset class?
Yes.
So what else goes in the alternative assets?
Really the only distinction between private equity funds, which you can do credit strategies too under this structure, right? Mezzanine debt, for instance, would be another private equity structure. The only difference in my mind is it a finite life fund where it's going to end after 10 years and you need to do it that way because you can't offer liquidity to your investors before you sell the investments? Or is it an infinite life fund where you can manage your liquidity on a cyclical basis and offer a floating liquidity, and otherwise the investments underlying it are irrelevant? Any strategy could be done in that has liquidity that matches what you offer your investors.
These are parentheses, because it sounds like there's a lot of different types of hedge fund. How about a real estate investment trust? Is that an alternative asset?
No.
No.
Also publicly traded, though.
Those are publicly
It
traded.
can be, yeah.
All right. Well, maybe it's just we're saying then that you have private equity, which can be a subset of private equity, which is in this general category that I hear referred to as alternative assets.
Would you like oil and gas alternative, like something like a mine that's producing some form of, set out for 10 years or something?
I put that under the private equity strategy as a sub-strategy. We're talking stage of business growth, and you can look at it as stage of business growth, or you can look at it as investment style and structure. And I think you could answer it differently with each perspective. So private energy, you're investing in a mine, it's a business, it's early stage, it's going to take a while and some money to start pushing out money when it does, and you've got an eventual exit. So you shouldn't ask me on the strategy, because I'm going to throw it back to the way you structure it.
But keep in mind, the mine is the company, right? We've got a continuum here where we've got investors, we've got a firm fund, and then we've got a company or an entrepreneur. All right, who threw out endowments for us? All right, you mentioned one more, besides hedge funds.
Pension funds?
Pension funds. Turns out pension funds are the number one largest investor in these. How about besides endowments? Can you think of anything else?
Sovereign wealth.
Pardon?
Sovereign wealth.
Ooh, nice one. What's a sovereign wealth fund?
Countries with money to spend.
Okay. Anything else? I would argue that a trust is kind of like an endowment. Anybody heard the term fund funds? Anybody know what that is?
Fund of funds?
Yeah, fund funds.
Isn't that a venture group compiled by the state of Utah?
Utah has one.
They invest in other funds, other VCs.
Yeah.
There's funds to invest in those funds.
Yeah. So a fund of funds is an investor.
It's a middleman.
It's a middleman, right? And we'll talk about this one. This is kind of a special case. Anything else? These are all corporate entities. Did you have a person be an investor? Okay. So you could have a high net worth individual. I specifically say high net worth because as an individual they have to be accredited. Interestingly, who governs the public securities markets? The Securities Exchange Commission, the SEC. Who governs the world of private equity?
In a limited way, the SEC, but not really as much.
Yeah, I would, in a limited way, right? Mostly because they don't,
Yeah.
they don't
It's
control
a
that.
hands-off approach.
It's mostly hands-off approach, right? It's kind of a self-governed sort of world, right? SEC draws this line and says if it fits in this category, then we're going to govern it. And if it meets these other characteristics, then it's going to be self-governing. And one of those characteristics is the definition of what makes up an accredited investor. So the idea for this is it's actually in the private equity world, it's in their best interest to make sure that they police who the investors are in these businesses, because they want to keep from being governed by somebody like the Securities and Exchange Commission. Is that fair?
Yeah, I would say that the firm, as in the advisor, the GP, is regulated much more by the SEC than the fund itself. So it's the LPs don't always see it, but the GP's got reporting obligations to the SEC and informs they do file.
Do they all?
The exemptions are getting fewer and fewer.
Okay. I think we're probably still running under exemption. We're not going to try and go low under exemptions. I can report on my new fund.
I can't answer that, I don't know.
All right. So, okay, we've talked about what these groups of individuals look like, what their characteristics are. Before we talk about fund funds, let's talk about pensions for a second. Whose money is in pensions? Whose pensions are they?
State
Pardon?
employees.
Are they companies' pension funds?
Yeah, they're companies' pension funds, right? But sometimes they're, like public entities, like
Community college and stuff.
yeah, have their own pension fund. So whose money is that?
Employees.
Okay, employees, right? So you can think of this in one way as this is your parents' pensions, right? But for those of you that are in these organizations, like it's your pension, right? But I think it's easier for me to think of it as it's your parents' money. So that way, if you have entrepreneurs come in and they're like, hey, I can't believe these guys, what arrogant bunch of jerks that couldn't see how great my business idea is, they sometimes would have a different approach if they realized it's not their money, right, the general partner's money, it's the entrepreneur's parents' money that these folks have a responsibility to make investment decisions for. And if they make investment decisions that are bad investment decisions, then these folks stop investing in the firm. And these general partners have to go find something else to do other than run. Okay, fund of funds is an interesting case because in this case, you have an entity like a sovereign wealth or endowment or a pension that wants to make an investment, and they go through another entity. So they pay a commission to be able to go through a third party. So there's like this group. Goes through another entity and makes an investment over here. And they charge them, I don't know what they charge them, let's say it's 0.5% or maybe as much as 2%, depending upon how much money it is, right? The percentage will go down as the amount of money gets bigger. So why would an endowment choose to go through a fund of funds instead of making a direct investment with a private equity firm? Think of this as a broker. Why would they use an intermediary or a broker to make these investments? Yeah.
They don't want to deal with the investment themselves. They'd rather just have somebody else manage it.
Yeah, that's definitely one good reason, right? Because it takes a certain amount of expertise in order to be able to do something like this. And they might not have that expertise in-house. And it might not be cost effective for them to be able to develop it. Okay? Any other reasons? Yes?
Diversification, instead of putting in just one fund, but having investment strategies to spread it across. Still get that exposure, but spread it across.
Yeah, so diversification is a really good reason. And we'll talk about why you would want to diversify something like that in a minute. Typically, if we talk about this as an asset class, if you're a pension fund and you're a $10 billion pension fund, right? What percentage of your $10 billion are you going to put in stock market?
Globally,
Yeah.
35 to 40.
Okay. Because I already have somebody that does this. 35, 40% in stock. How about in bonds?
Off the top of my head,
Yeah.
20, 25.
You remember you're going to go on the continuum here. How much goes in the alternative asset class?
You want to break that down to private equity and other?
We can do that now, or we can do it after we decide to.
Is real estate part of alternative assets?
Sure.
Public pension or corporate pension?
What do you want?
35, 40%.
So then how about in just private equity? Out of this 35%?
15.
So what is 15% of $10 billion? 1.5 billion, right? So if you're a pension fund and you have $1.5 billion to spend, how much can you put in each entity of here? Suppose you could make $10 million investments in each one. How many investments would you make? 150, right? So you have 150 different things in your portfolio, and they'd be 10 million apiece. And you would have spent 1.5 billion, which gives you exactly 50% of this entire $10 billion. Does that make sense? If you have good diversification, you have 150. All right. What's the current diversification philosophy? How many do you have to have? 30? Okay. So we're well above. We're 5 times above. All right. Suppose you are an endowment. Can anybody name an endowment or a trust?
Bill and Melinda Gates.
Bill and Melinda Gates Foundation. How big is that one?
I don't know.
Okay, that's a big one though. Does anybody know who, let me go to the other end of the spectrum. Does anybody know who Ray Lloyd Olton is? Yeah. I haven't heard that name. It's a building here on campus, right? And the reason there's a building here on campus is because Ray Lloyd Olton has a trust or an endowment. And he built the building for the students. That's the student building, isn't it? Yeah. Okay. So that's Ray Lloyd Olton. All right. So suppose for a minute he's got $100 million in his trust. Okay? And he wants to have, or his whoever's managing the trust at this point, right, it's going to be his descendants. He wants to have the same sort of allocation. He wants to have 10 to 20% in private equity. So how much in nominal dollars is he putting in private equity? $15 to $20 million, right? Can that trust get good portfolio diversification by making $1 million investments? Maybe not million. Maybe if they were like $500,000, maybe we could get 20 to 30, right? If they're making $5 million investments, they can only make 3 investments. They can't get diversification, right? So you can see how you need a bit of a middleman in order to be able to reach that sort of diversification.
So it's for smaller investors with less money can join the larger groups and more of that.
So this begs the question of why would you invest in private equity in the first place? If you had to go to the trouble to pay somebody a commission, why wouldn't you just put your money in stocks or bonds or something else?
Higher returns.
Higher returns, right? What are the, say, 20-year returns for private equity? Over the last 20 years, how has private equity performed?
20%?
20%. It might be a little high. They're pretty close. Anything?
The stocks are like 7, right?
Okay, the stocks at 7%. How about bonds?
Less than that, 3.
Okay, those 3 are generous between 4%. Okay, how about real estate?
Not so great last 5 years.
20.
Oh, 20.
Real estate's tough because the 5-year real estate is really different than
5%?
I have no idea, right? So I'll just say 5%. But if you're looking at this, why would you only put 15% of your money in something that returns 20%, and put a third of it in something that's only 7, and then a quarter of it in something that's the lowest performing one of all?
Risk.
Diversifying your portfolio too. Diversifying your risk. Efficient
I don't know if I'm going to try to cover efficient frontier, but we'll just call it a diversification strategy, and we'll let Jonathan cover the rest.
You also, I mean, this is very high level, but as you get into the sub-strategies of each of these, you change, they're not all correlated, right? And that's the biggest reason for URS going into hedge funds in 2006, 2007, was to provide the equity-like return with a downside protector on it. And so in up markets, the correlation is above 1, and in down markets, it's inverted. And so, as different asset classes go in and out of favor, you're maintaining a portfolio with more volatility.
So diversification, risk, volatility, that's what the limited partners are thinking about when they're making these investments in firms. And they have investments in different types of firms, partially because they have different expected returns, and partially because they have different volatility levels, and partially because some of these are less correlated to each other. So, questions about how the limited partner and the firm relationships work? All right, just to recap, why are the limited partners limited?
Limited risk.
Limited liability, limited control. Okay. I think I've done a little bit earlier. Yeah, it's probably good right now.
While you're erasing that, I'll mention the third thing about fund of funds. We talked about diversification and the sophistication of the resource that a fund of funds might give a smaller investor. Sometimes there are private equity firms out there that are in such high demand, and they're only going to take $500 million or $1 billion or $2 billion, and they honestly don't think they can put more than that to work and still get the returns they want. So they will not accept more than X 100 million or billion or
So they kind of
tens of millions for their first fund. So you may be fighting to get even a spot as an investor in that fund, and the fund of funds spend a lot of time on their relationships with those higher GPs. So you might get access to some GPs you might not otherwise get.
Do they kind of do that so that if an LP walks away, they're not with a liquidity crunch? They kind of manage their liquidity by having more investors with smaller amounts invested, or is that the primary reason, or is it different?
So when you're signing up for the private equity style as opposed to the evergreen infant-life hedge fund, you're committing on day one for how much money you're going to put into that, and you're not putting it all in day one. They're going to call it as they get their investments ready, but you don't have the option of walking away. So it would be smart as a GP to have more investors in a way to manage the default risk of those limited partners not making the payments they say they're going to make. But those pension funds are probably very high credit, and it would be a lot easier to administer to a smaller number of LPs if you trust in their credit and you don't see that risk.
So you don't necessarily have a lot of banking that you want to still have some of the bar for the investor.
Yeah, there's probably a sweet spot.
So it's interesting that as an entrepreneur, would you be better off having one investor or three investors? Three. Why do you say three?
Less risk.
Less risk? So it could be that you could get more money, but it's conceivable also that you could get one investor who would put in a whole bunch of money. Right? Why do you say less risk?
Just because if one, just like we were talking about before, if one has some kind of cold feet or some change, you don't lose the whole thing. I mean, it's easier to go out and replace one than one smaller one than one big one.
Yeah. So these funds exercise a certain amount of control over the entrepreneurs and the company. And the entrepreneur has less control essentially if there's three investors that have 10% rather than one investor that has 30%. And part of this comes into effect where supposing the entrepreneur needs more money, right? And there's a negotiation over valuation, which happens all the time, right? Then all that power is consolidated into one particular firm. And it's hard for somebody else coming in to say, hey, how come you're raising money? Why doesn't your old investor put more money into this business, right? They know more about this than anybody. They should be super excited about it. It's hard to say like, well, we got into a fight with them, so we don't really like them anymore. We want some new money, but it's still a great company, right?
We're easy to work with too.
Yeah. Or even suppose the firm wants to say like, oh yeah, they're a really good company, but we just don't have any more money. So the new investor is like, wait a minute, do they really not have any money, or is this really not as good a company as the company is saying? Right? You've got similar dynamics when you've got firms and limited partners, especially if you have this fund cycle where the firms are going to go back out and try and get new investors. When the company is trying to do due diligence on the firm, they'll call other companies that the firm has invested in. They're smart. Sometimes they're just so happy to get a check they never bother to call. That happens unfortunately a lot. But if the firm wants to do due diligence on the company, then they'll call different companies that the executives have worked for in the past. On the limited partner side, these folks have a lot of influence and control over the firm. If you're a new pension fund thinking about making an investment in a particular firm, you might call the previous set of investors and say like, hey, what do these general partners like to deal with? Do they get their reports out on time? Do they make good decisions? Do they, when they tell you they're going to execute a certain strategy, do they stick to that? Are they trustworthy? That kind of stuff. So some interesting dynamics. Having multiple sets diversify some of that risk. So if you have a pension fund that drops out, but you have two pension funds that stay in when you raise a new fund, then it's a lot more believable for the new pension fund looking at it to say, well, yeah, one person dropped out, but two people decided to stay in, so there's some group of people that continue to endorse this firm. Yes?
When you're raising these funds, do they write you a check when they commit, or is it just a promissory note that we're going to give you X amount of dollars and so you
that you draw on.
So it's a little bit of both. You never, in the funds that I've had in the past, which are these 10-year funds, you don't write a check for the entire amount of the fund. There's a capital call where you make a commitment for say $1 million, and you have to write a check for maybe $100,000, right, if you're an individual. And then every year they promise that they won't ask you for more than $150,000. Otherwise, you run into this liquidity crunch where the firm says, hey, we've got this new company, we need $5 million. You ask all our folks for money. And this group sends their check, and this group sends their check, but then these two groups essentially don't have enough money to be able to make a call. Then you're stuck, right? Because you don't have enough money to make an investment.
It's called a capital call.
Capital call.
And along that line, what's the other question I have is, we talked last week about like the operating costs, how that comes up. When you're raising funds, how does the firm pay the bills before they have any, and they start taking the operating costs out of that?
I'm not going to spoil Jonathan's stuff. Jonathan's going to talk about that.
One more plan, I'm sorry.
So let me just give you one example about the diversification issue here, and the specific example of when the company needs a certain amount of money. If the company needs $4 million, and the firm says, here's an agreement, we will pay $4 million. And then they go after the limited partners and they ask for 8% capital call. And all total, a couple investors are short, and they come up with $3.5 million. What happens? So you don't have enough time to go out and get a new set of investors.
You spread that among the ones that still have good credit and money.
Yeah, so then you essentially have to go back out, and you have to ask the rest of these folks for, what is that, 12, 13% more than what they came up with last time. And what if some more investors drop out, and then you only end up with $3.9 million? And you have to go back again and ask for a small amount more. So in order to not have to do that all the time, because it's a huge hassle for limited partners, and it makes the general partners look dumb, typically what happens is that there's some sort of line of credit that they can work with, so that they don't have to, so they might even be able to write a check for $4 million and then wait until, a certain period of time before they ask for, the $4 million and maybe even some more for the next investment. So that's one way to see that.
How common is that for investors? I mean, I know that you're saying some of the pension funds and things like that are very high credit individual and groups, but how common is that for you to have to go back or to have that crunch? Is that a major problem that happens a lot?
I don't see it in the funds. We're usually in very well established funds, not a lot of venture capital.
But my guess is your docs still say, we promise we will not call capital from you more than once a quarter, something like that, right?
They don't. No, we're not so concerned about the frequency. We'd rather get it to work.
Okay.
I can understand that. But it should be said that the default provisions of the partnership agreement are extremely harsh on those investors that do not make their capital calls, and in a way make it worthwhile for those that step in to fill the void. I think that market is that one default by a limited partner can dilute them 50% from their current investment. So let's say they got halfway through this fund, and they put a $10 million commitment in. So they made a capital commitment of $10 million. It hasn't been called yet. 5 of it's been called, and then at that point they run into a cash crunch and they can't make the next call. It's very typical to see the general partner at least be empowered to take half of the $5 million of investments that investor has already put in, and give that as an incentive to the other limited partners that are having to put in more. It also creates problems for the limited partners because they may have relied on, in this scenario, they could have negotiated up front, hey, we have diversification requirements, and we will not allow you, we will not sign, we will not commit if you won't agree that no individual deal will exceed 10%. And so this 8% was fine until that you had to come back to the LPs and say, now you got to put in a little bit more. Well, now you've just been putting 10.5% into a single deal. That violates my investment policy as a problem. So that might be something you negotiate up front, saying that in case of default, you're not going to have to put in more than the diversification needs of the fund, but maybe you could have a line of credit. I mean, what it really means is down the end of the company, there's going to be one investment that's, towards the end of the investment period, you might have invested in. It's not that you don't have the money, it's that you run into the limit and you've got to come up with the cash money and have to
So those penalties, they're spelled out in the partnership agreement?
Yeah, those would be the default provisions.
Okay, and so you could make them whatever you wanted. They could be as strong as you want. In this scenario, you're saying maybe 50%, but it could be even more aggressive.
But the
But that's
LP
not-
would have to agree with it.
Well, see, when you sign up for a fund, when you sign that subscription agreement, you're agreeing to be a partner and to be bound by the partnership agreement.
Right.
And that's why you better know what the default provision was before
Yeah.
you made your.
It just could be difficult to get your limited partners if you went beyond the market term.
Right.
So
Yeah.
if you're doing a 90% penalty on that default provision, instead of 50% penalty, it's normal.
Yeah, expect to pay somewhere else in the term negotiation or just lose
Right.
limited partners who aren't willing to agree to that term.
And if all of your limited partners are pension plans in the billions of dollars, they're probably not really worried about their own default. So a higher number is not going to concern them. But when you get to high net worth individuals and maybe smaller endowments, they will return that.
We thought one last story before we take a break. We take a break, right? Consider yourself. So there was an interesting thing that happened when we talked about concentration limits 5 or 6 years ago. And that was that some of these folks, like the pension funds, said, hey, our alternative class is only going to be 15% of the fund. Okay? So suppose the pension fund is $1 billion and it's got 35% stocks and I'm just going to make this a little bit simpler. 55% bonds and 10% private equity. So what happens? What's the dollar allocation between those three? How much do they have in dollars in stocks? How much do they have in bonds?
550.
And have 100 million in private equity. So what happens if the bond market tanks and drops in limited private equity stock?
No, all of a sudden their percentage that's in PE and stocks goes up.
Yeah, so if these numbers are 350 and now 350 and now 100 million, what, I guess in this case we said 15%. What if your allocation was just 10%?
So their funds drop in value, so they have to take money out of stocks and private equity to keep that same ratio in bonds. So you end up with one new fund in the private equity portion of the portfolio.
So essentially, or what happens like this? What happens if stocks drop and bonds drop, which would be unusual together, but then private equity goes up? Now what percentage are you?
One that's
1/5, 20%.
So now you're 20%, but you've got a document someplace that says you'll only be 10%. So what do you have to do in order to get to 10%? So you have to sell your private equity holdings in order to get back down to 10%. Is that something you want to do?
No.
What's your top performing asset in this particular scenario? It's your private equity scheme, right? You guys probably didn't run into this, but some of the limited partners that were in the markets had these sort of provisions when the other markets dropped, they found themselves holding a disproportionate amount of something that they had. And they literally had to go back out and sell something it was otherwise outperforming. So what happens if you have all of a sudden a bunch of folks that go into the market and try to sell in the secondary market, try and find a bunch of buyers for something that's not super liquid?
You don't get top dollar, that's for sure.
You don't get top dollar. And there was a day when supposedly that the folks that were trying to buy these things in the secondary markets were buying them for 20 cents on the dollar. They were getting 80% off.
They're good investments.
And they're good investments, right? Those folks did well. And in fact, there's the whole idea of secondary funds emerged, where some funds would specifically be designed just to buy shares from other funds. So, I mean, some of those did really well. All right, anything else I should talk about before we take a break?
Secondary funds are awesome. If you're buying.
If you're buying them.
At that time,
Yeah, you don't want to be selling in the secondary markets.
I know this focus isn't necessarily from the investor standpoint, but it points out the importance of a commitment-based model, so that you know how much cash is going to be coming out of your diversified P portfolio every year, and so you're not doing it every 5 years. You know, it's a 10-year life cycle, right? So if you're going to put in $150 million, you're not doing that once every 10 years.
All right, any questions before we take a break? What do you think, 5 minutes, 10 minutes?
Let's do 5 minutes.
Okay, let's do 5, we'll start at, or 6 minutes, we'll start at 4 after.